Hello, this is Brian Resney, president of Resney Wealth Management. I'm bringing an update about the economy and the investment market so you can understand what we see in the global landscape. Well, of course, last week, China decided to cut one of their key interest rates, and of course, now Mario Draghi with the European zone is obviously looking to do more quantitative easing. We continue to avoid Europe, and I would, because bottom line is they can do all the quantitative easing they want, but the economy in Europe, generally speaking, the economies, I should say, are just really lackluster, extremely mature, and there's just no real great opportunity there. We continue to have a higher preference in U.S.-based equities, mostly on large cap, and that's been one of the almost only houses to invest in this year, is mostly large cap dividend paying on the equity-based side. As we get into year end, I firmly believe we have a potential for a continued rally. The U.S. economy is strong, and it looks like it's gaining just a little bit of steam. I firmly believe we can be in a long-term bull market for many years, as I've discussed in previous updates. And I firmly believe if you're in areas where the economic situation is growing and the valuations are reasonable, like we are currently seeing in the U.S., I think that's great opportunity for outstretched gains in a portfolio. I do believe that risk management, of course, is always an important aspect of portfolio management, and sometimes you give up a little bit of return in order to get that warm and fuzzy feeling and reduce risk in an overall portfolio. But we are seeing the U.S. economy doing well. Things look good for the Christmas season, and I believe as we get to year-end 2014 and we approach 2015, I think there really is a good potential for another decent year of the equity-based markets. We still are on the very low-term maturity on the bond side, and I firmly believe we've seen the low of interest rate in bonds. Even if bonds don't go up or interest rates don't go up, bond values are going to stay stagnant and interest rates are really on the 10-year around 2.3%. That's pretty hard to make a return on that considering you have inflation and taxes, but I think there's a lot of investors who are still on the wrong side of the fence in bonds or feel that bonds are ultimately the safest investment out there when bonds actually can be quite risky, especially when rates are as low as they currently are. So again, we continue to be really low average maturity, well under 2 years. This will help protect principal, still get some asset protection within part of that asset of the portfolio, but without any undue stress if we start to see rates rise in 2015. I firmly believe the Fed is going to be very slow, though, in raising interest rates, simply because the economy is growing, but not at a fast clip. And I think they're also somewhat worried about other countries outside the U.S. While those countries won't have a big impact on us, I think the Fed may be a little bit more subdued on raising rates, so we may see more of a stagnation or lower rate potentially for the next 1 to 3 years. If you're a client of our firm, give us a call. If you're not a client of our firm, call us for a consultation. There is a difference. We invite you to experience it. Make sure you have yourself a safe and profitable week and a great Thanksgiving.